This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Chapter 6, Evidence Itself. It says the above standard. It used to have a standard reference on it, but it no longer has a standard reference, so I'm going to take out that few words. The above standard states. The standard states. And I think we can have a small S there, I don't think. Oh, no, maybe a big one. The standard states that the auditor should obtain sufficient appropriate audit evidence to be able to draw conclusions on which to base the opinion. The evidence is obtained a number of ways, including appropriate tests of control and substantive tests. Sufficient. This expression, I find it difficult to imagine that you will leave the exam room in 10 weeks' time without having written somewhere the expression sufficient appropriate audit evidence, or sound system of internal control, or obtain a thorough understanding. These are phrases which fit nicely into any auditing answer. Sufficient appropriate audit evidence, sound system of internal control, or obtain a thorough understanding. You'll find you can get those into many answers. What does sufficient mean? What factors will influence sufficiency? When you know that enough is enough.
When it makes you feel confident about your...
When you have reached in your own mind a conclusion that says, I have enough evidence to support the figure. I have enough evidence to confirm in my mind that the figure in the financial statements is within material bounds, is reasonable. Yeah, okay. How do you arrive at that? Judgment, skill, experience, yeah, okay. So factors influencing sufficiency, two of the factors would be the auditor's own professional competences. And that comes down to experience. You could say that sufficient is where the acquisition of one more bit of evidence about this matter is unlikely to change my view of the matter. So we've reached a stage where the marginal benefit to be gained is outweighed by the cost of obtaining that marginal benefit. I had a client who made what's called folding campers, and it's a mixture of a caravan and a tent. So they drive along to a campsite with this very low-lying, very low-level caravan on two wheels, but it didn't look like a caravan. But when they got to the campsite, they took the tarpaulin, took the cover off, and they then opened up one side and it became a double bed, and opened up another side and it became twice the length of what they'd just towed, with two double beds. And then they lifted up and created a shower cubicle, and they lifted up and there was a toilet cubicle, and they pulled it out and there was a kitchen. A very clever design. When I did their inventory, when I attended their inventory count at the end of the year, I could do it in 5 minutes. All I had to do was count the number of campers, folding campers that they had, each of them worth anything up to £7,500, and I could count the number that they have of the different designed campers, multiply it out, and they'd give me a total inventory figure. They gave me a total inventory figure and said, we have this much in, say 100,000. But I just counted 90,000's worth of finished caravans. What's the value? What's the point of me counting their stock of wheels or their stock of gas canisters, or their stock of tow bars. What's the point of doing that when I've already established 90% of the stock value? The marginal benefit is minimal compared with the effort of counting. When is sufficient sufficient? When it's sufficient, when it's enough, when in the auditor's judgment I have verified enough in my own mind to be reasonably certain that the figure for inventory is materially correct. Other factors influencing sufficiency would be your familiarity of the client's activities and the reliability of client management and your assessment of their integrity. Another would be the materiality of the matter in the context of the financial statements. I'm not going to pursue at great length the collection of audit evidence about something which in the context of the financial statements is only just material. I'm not going to go on and on and on doing this. I remember when I was a junior, it didn't happen to me, but I heard it happen to a friend of mine, and he was told the senior, what a waste of time this is, the senior had written out a schedule and put it on last year's file. And it was a schedule of the number of forks that were in the canteen of the client that we were auditing. And he'd written out this schedule that said different types of forks. There were cooking forks, and there were dessert forks, and dining forks, and table forks. And he'd written out the schedule of the number of forks with a comparative figure showing how many forks there were last year. And he said to the junior, this year we're going to count the spoons. And the junior went and counted teaspoons, tablespoons, dessert spoons, soup spoons, cooking spoons, and went and counted them. And it was a joke by the senior. What a waste of time. Fireworks would happen nowadays if that happened, but this was in the good old days when auditing was fun, rather than now when it's just pure pleasure. What other factors will influence the sufficiency? Your knowledge of the client and the history of the client. The reliability of the client and their accounting systems. The reliability in your assessment of the controls. The accounting and internal controls. The expression in the top line says we need to obtain sufficient, appropriate audit evidence. We've just looked at sufficient. But what about appropriate? It means that the evidence is relevant and it's reliable. Two elements there, relevance and reliable. It must assist the auditor to form an opinion. It must be trustworthy. It must be persuasive. For evidence to be reliable, there are four general presumptions. This was covered at F8, but I don't feel any guilt about going through it at F8. But written evidence is better than oral evidence. Better to have something written down rather than just spoken to you and you make a note of it later. Independent evidence from outside the organisation is preferable to evidence from inside the organisation. So third-party evidence is better than the client's produced evidence. So you'd get a letter from the bank, you'll get a certificate from the bank, you'll get certificates from valuers. You'll get a certificate about the level reached in a construction contract. You'll get a certificate from the lawyer about the likelihood of the outcome of the probability of the outcome of a legal case. Third-party evidence is better than internally generated evidence. Original is more reliable than copied. Original evidence rather than a photocopy, because photocopies can be manipulated. Having said that, original evidence can be manipulated as well. That you can maybe get a letterhead and scan it onto a blank piece of paper in colour, type up the evidence that you want to produce, sign it with a forged signature and present it to the auditor. But it's original, it's not copy. The only difference there will be that the auditor should not be given evidence, outside evidence by the client, the auditor should write to the third party and get direct confirmation from the client. But original is better than copy. I've seen bank statements which have been manipulated, where they've scanned it, copied, changed it, and then printed it off as original. I've seen that happen. Evidence generated by the auditor is more reliable than that generated by the company itself. Auditor generated, simplistically, if you think about doing a circularization of receivables, it's you that chooses the receivables. It's not the client. It's not the client that says, I've written to these receivables and they've confirmed their debt. It's you that chooses the receivables. And from that moment of choosing, you are in charge of the process of preparing the letters, filling in the gaps, putting them into an envelope, putting a reply paid envelope into the envelope that you're sending. The reply paid envelope addresses the reply to your offices rather than to the client. This is basic stuff, isn't it? For you auditors, this is basic stuff. For you non-auditors, it may be overkill, maybe. Why should you not write the letter to your receivables and simply produce these confirmations to the auditor? It's no good. They would ignore it. They would just ignore it completely. Procedures for obtaining evidence. There's 7. The first 5 you can remember easily. The last 2 are relatively new additions, but they're common sense. The last 2 previous audit file, look at last year's audit file, that will give you a lot of evidence related to this year. And reperformance is another one which doesn't fit in nicely to the first 5. I'll look at the first 5 in a moment. Reperformance, the client has performed some exercise. The auditor reperforms that exercise to confirm the reliability of the client's work. So don't take on for face value. Don't take everything that the client says as being totally reliable without reperforming some of the work. Reperforming non-reconciled replies. You give the replies, or the client themselves looks at the statements received from suppliers and reconciles them and says reconciled. You also do that reconciliation exercise just to test that the client is doing it properly and is reliable. The first 5 are easy to remember, because it's the vowels from the English alphabet. A, E, I, O, U. Analytical, inquiry, inspection, observation, computation. Analytical procedures we've looked at. Inquiry, you've said it twice to me already today. Ask. What better way of finding out answers to questions than ask the question? Inspection. Actually inspect the premises. If they say they've got a new sports ground, go and inspect it. If they have an asset up near Acropolis at the top of the city there, if they say they have an asset which is a new sports stadium, go and inspect it and you'll see that it's still a skeleton and has been for the last 20 years. Has that skeleton of the sports stadium been like that for 20 years? Even though they did a little bit of work on it 3 years ago before the financial crisis. Yeah. Go and inspect it. Observation. Watch how processes are being carried out. To observe is not the same as to inspect. To inspect is to physically go and look at an asset. To observe is to observe a procedure being carried out. They're not quite the same. And computation is, for instance, it may be that the client has a detailed analysis of their receivables, but they have not analysed old debts. They've simply said more than 2 months, but they've not analysed it into 3 months, 6 months, over a year. So you could yourself analyse that and compute it. So computation, to give you a degree, or give you an indication of the percentage of the overall receivables which are greater than 6 months old, for instance. Example 2, I'm going to ask you to do that tonight as well, because that will then get me onto page 35, which is written representations. It's part of evidence, but there's no way we're going to be able to finish evidence tonight. So, well, maybe we could, you know. No, it's not. It's chapter 6, isn't it? No, we're not going to be able to finish evidence tonight, so I'm going to leave it. Can you do example 2 on page 34, and we'll start tomorrow on page 35. So that's 2 bits of homework. Yeah, I gave you a bit before.
3 actually.
3 bits of homework. What was the third?
You have to remember that Indra does...
Indra only does regular activity. Yes, okay. What was it? I?
Introduction.
O?
Objective.
Objective. D?
Definition.
Definitions. R?
Regularities.
Not regularity. That's what she does at her actions. Requirements. And A? Application. Okay. Page 35. Written representations. These used to be called management representations. It would be wrong to use the word management representations now. The title has changed. So they're written representations. What these represent is the formal written confirmation by management of oral statements made to the auditor during the year, during the course of the audit. Remember I said yesterday that... Hello. Water has arrived. Remember I said yesterday that an audit file should speak for itself in a court of law. Nobody's watching me or listening to me. Everybody's looking at the water being dropped on the table now. So we'll just wait for a second. Thank you. An audit file should speak for itself in a court of law. That is, you give the file to the court and say, there you are, that's the audit. And that's the basis and the corroboration, the support for our audit opinion. But when auditors ask questions during the course of an audit and they get an oral response, because they don't write out the question, they don't write the question out and give it to the person and then stand there and wait for the person to write a reply. They just ask the question. They come back to the audit office and they make a note within the audit file that says, I asked this and this was the reply. But that's no good, because we need the formal confirmation. The director or the person that you've asked could potentially deny that they ever said anything like that, or they said something like, but it has been misinterpreted. So written representations are the formal confirmation of the oral statements made during the course of the audit, in order that it can be sitting there on the file, and when a court looks at it, in the case of a negligence action against the auditor, then the auditor says, I asked the question, I got the oral response, I then later confirmed in writing or got written confirmation that this was the response that was given to me at the time. So that's what written representations are. We should obtain written confirmation of appropriate representations from management before the audit report is issued. Yes, we should, because it's part and parcel of the evidence which justifies the audit report, the audit opinion. The auditors should obtain evidence that the directors acknowledge their collective responsibility. Again, I said it 2 or 3 times yesterday, that on every occasion where it is applicable, the auditors will repeat the fact that it is the director's responsibility for the preparation of the accounts, for the maintaining of the company's accounting records, and so on. So within this letter that we're asking for, within these written representations that we're asking the directors to provide us with, will be the paragraph that says, we accept, because it's signed by the management, we accept that it is our responsibility to maintain the accounting records and for the preparation of the financial statements. It's formal written confirmation of their acceptance of their responsibility. The representations provide necessary audit evidence, but they only act as support for other evidence. It's the final brick. At F8 I like to think of evidence as a wall built of bricks, and you collect evidence about various matters and you build a wall of evidence. So with reference to, for instance, receivables, you'll check the sales records and the sales system, you'll check the cash collection, you'll check the system for the raising of credit notes, and you'll check the work which was done before we wrote off any receivables, and we'll build up a wall. We'll use analytical review to see whether the receivables figure appears reasonable in the context of and the knowledge of the company. And one more element of evidence, one more brick in the wall, is these written representations. But it cannot be the only brick in the wall. There is no situation where auditors can rely upon written representations as being the only evidence that they collect with reference to a particular material matter within the financial statements. So it only acts as support for other evidence. And if the brick doesn't fit in the wall, if management's written representations cause a little bit of doubt about the conclusions that we've reached on the other bits of evidence, then the whole thing is cast into question, cast into doubt. They can never be used, the third bullet point there, they can never be used as sole evidence on any material matter. In addition, we require written confirmation from management that they have fulfilled their responsibilities for preparing the financial statements. They have provided the auditor with all relevant information and explanations and access to records and personnel as agreed in the terms of the engagement, and they've recorded and reflected in the financial statements all the transactions applicable to the company for the year. I'm looking again at the DEVRA report, at the audit report on page 81, and halfway down the second column there it says, matters on which we are required to report by exception. Under the Companies Act 2006, we are required to report to you if, in our opinion, adequate accounting records have not been kept. And the fourth bullet point, we have not received all the information and explanations we require for our audit. And just going back to the first column on that page, the first subheading, respective responsibilities of directors and auditors. As explained more fully in the Statement of Directors' Responsibilities, the directors are responsible for the preparation of the financial statements and for being satisfied that they give a true and fair view. And going back to page 21 for the director's own report, where it says Statement of Directors' Responsibilities in the left-hand column on page 21. Directors are responsible for preparing the annual report, the remuneration report, and the financial statements in accordance with applicable law and regulation. Company law requires the directors to prepare financial statements. And so it goes on, and every opportunity we get as auditors to reaffirm this concept that it's the director's responsibility and that as independent auditors, all we're doing is carrying out an audit function. Going back to the notes, back to page 35, if there's any doubt about management's integrity and therefore the representations are potentially unreliable, or if management refuses to provide written representations, what would you do? This representation letter, this written representations, will not normally be a voluntary submission by the directors because the management don't know what representations the auditor would like to have confirmed. So it will be the auditor that prepares the letter, but it will be signed and it will be on the letterhead of the client. So the auditor will prepare it with the assistance of management and give it to management, who hopefully will discuss it at a board meeting and then will approve it at a board meeting, and there should be a minute of that approval authorising the chair or authorising the chief executive to sign the letter on behalf of the board. But what if they refuse to sign? What would you do? Make a note in the report that it's too much too soon. Yes. Ask why not. Ask why they are refusing to sign. What is and what's the problem? Because this is surely a fair record of the statements that you gave us during the course of our audit. And it may be a perfectly sensible explanation. It may be that you've made a spelling mistake in there, or they've spelt the company's name wrong, or you've dated it in the wrong year, and so they're not going to sign it because you've made a mistake when you drafted the letter. It may be that circumstances have changed. When you did ask the directors about contingent liabilities and outstanding court cases, they gave you an honest response at the date that you asked them. But since then, there's been a time period between you asking and now you're asking for this written representations. Circumstances could have changed. Now, in practical terms, the directors themselves should have come into the office, the audit office, and said, look, we've heard from our solicitors and the situation has now changed with reference to this outstanding legal case. But they may not have done. And it may be therefore the case that their original response was perfectly honest and according to the situation as it did exist, but that was 2 weeks ago, and things have moved on since then. So ask them why they're not prepared to sign these written representations. If they are unwilling to sign, it may be because in the UK, if directors knowingly or recklessly give false information to an auditor in pursuit of their audit inquiries, the directors can face an imprisonment. They can face prison up to 2 years. So if they refuse to sign, it's possibly the case that they have been lying to you. So you need to determine whether the integrity of management is such that you could rely upon them. They may refuse to sign for the reasons that... Do you know what, for instance, Indra's unmarried name was? So do you therefore know what Indra's father's name is, or her uncle's? You don't know, do you? And it's therefore not reasonable to expect any director to know the full extent of the related parties of the other directors. And in these Devereux accounts, it says related parties. The group had no related party transactions other than the remuneration of the directors. But how does any individual director know that? So I'm going to give this letter to the chief executive and ask the chief executive to sign it. And if the chief executive has got any sense, they're going to say no, because I don't know the full extent of other people's, other directors' related parties, for instance. So that's why I suggested that it would be probably better, preferable, to get the letter, the written representation letter, to be approved by the board of directors. And the chair of the board of directors is going to say, we come to this paragraph in the written representations from the auditors, we come to the paragraph about related parties. Now I don't know who your related parties are. Can you individually please confirm for me that there have been no related party transactions? Now an alternative to that will be to have individual letters for individual directors. So I confirm that I have made complete disclosure of all my related parties, and to the best of my knowledge and belief, none of my related parties have had any transactions with the company. But you need that information, and you need the completeness of that information, because if any director is lacking in integrity and is unwilling to be totally transparent, then the information in the financial statements becomes unreliable. In what situations are written representations an appropriate source of audit evidence? Just looking at example 3 there, do you know what that's reminded me of? It's reminded me of the homework that you did last night. This morning. Yeah. And we did, all right. And were there any problems with that homework? Wasn't a great deal of it, was there? Were there any problems with it? What's the structure of as a result of the Clarity project? What's the structure now of an ISA? Introduction. Sorry?
Remember next letter.
What was the next one? Objectives. And then came... definitions. R was requirements, and then A, application. Yeah. Okay. In what situations are written representations an appropriate source of evidence? Now, when I was a trainee, these written representations, these management representations, or the representation letter when I was a trainee, we used to write pretty well. We used to write out in longhand all the figures from the balance sheet and 1 or 2 items from the income statement. And we would get the directors to confirm that the tangible non-current assets were fairly stated at cost less historic cost less accumulated depreciation, and we'd identify the figures and we put in brackets the comparative figures, and we'd go right the way through that the depreciation policy was appropriate to the company. And there's a reluctance about 20 years ago now a reluctance in company management to say, why am I confirming this when it's information that you can find out for yourself? Surely it's up to the auditor to determine that the fixed assets are correctly stated at the historic cost less accumulated depreciation less impairments, and that the depreciation policy is appropriate to the different classes of asset, and that receivables are fairly stated net of their provision for doubtful debts. Surely that's all stuff that the auditor can do. So, I say about 20 years, maybe a little bit more than 20 years ago, this growing reluctance on behalf of management caused a radical change within the contents of written representations. And it's now pretty much restricted to those areas where there is an insufficiency of alternative audit evidence, where we're not able to get enough evidence to satisfy ourselves, and we just need that written confirmation because the oral statement by the directors is quite a fundamental piece of evidence. So where there is an insufficiency of alternative audit evidence will be one of the situations where you would expect written confirmation from the directors. Another area is where knowledge of the matter is confined to management alone. It's really the same point, but if a figure or an amount or a statement within the financial statements is as a result of management estimate or knowledge which is confined to management alone, nobody else knows, and it's not reflected in the accounting records, something like related party transactions. In that situation, then it would be appropriate to include it, a paragraph within the letter of representation, within the written representations. So, where there is an insufficiency of alternative audit evidence, or where the matter that you're seeking confirmation about is subject to management estimate or subjective assessment, or where only management are likely to know the full details. But it would be wrong for you to confirm that, for instance, the share capital of the company is correctly stated at 16,483,000, because you can confirm that for yourself. You can see that any subsequent issue of shares this year should be reflected within the financial statements. Should be reflected, within the financial records. Procedures: the chair of the board or other appropriate senior management should sign the letter, or it should be approved by board resolution. It should be dated after the completion of all other audit work, but before the date of the audit report, or on the same date as the audit report. Why? Because it's the up-to-date situation of the oral responses. This thing about contingent liabilities or outstanding court cases, you can't commit and can't reach an audit opinion unless you have all relevant information which is appropriate to those financial statements. So as the very, very last minute, you want to have those written representations in front of you, written confirmation in front of you. The examiner asked it in a recent exam that the partner's already signing the accounts tomorrow, but there's a little bit of work to do, and the written representations will be submitted to the audit firm next week. But he's going on holiday at the weekend, and he wants to get them out of the way. So the partner is going to sign the audit opinion tomorrow, Thursday. But can you make sure that we get the written representations next week? And it was clamouring, it was shouting out to you, this is not appropriate, this is not a sensible thing to do, it's not an acceptable thing to do, to get the written representations after you have expressed your audit opinion. Page 36, using the work of an expert. An expert is any outsider, isn't it? A person who's an expert in their own particular field. They possess special skills, knowledge, experience in a particular field other than auditing. Give me some examples. Actuaries, yeah, actuaries, so particularly with reference to pension costs. Another one? Jewellery and gold and gemstones, diamonds, If you put a piece of glass and a diamond in front of me, I wouldn't be able to know the difference. A piece of shattered glass, I wouldn't be able to tell the difference. Women can tell the difference. They can see that it's glass or diamond, but men can't do that unless they're particularly skillful in that area. So, stock, inventory valuations and inventory qualities. Another one would be?
Property, plant and equipment valuations.
Maybe property, plant and equipment valuation. If it's on a fair value basis rather than on a historic cost basis, yes, okay. Where we're revaluing the property on a regular and frequent basis, then we may feel as auditors, we may feel justified in engaging the services of an outside valuer or an estate agent. Something else? I've got in my mind construction contracts where the revenue recognition and the cost recognition is dependent upon the stage reached. I was involved in that myself. There was a new underground station being built in London, therefore a number of years ago. But as a junior audit assistant, I had to go down the underground station and have a look and determine in my own mind whether it was 58% complete or 62% complete. How would you do that? I stood there in this dark tunnel looking around thinking, it's probably 59% complete. How would you do that? So you engage the services of a construction engineer or a quantity surveyor, people then with the specialist skills. Another outside expert will be a lawyer to give you the written confirmation about the condition of an outstanding legal matter. So there are a number of situations where we would be justified in engaging the services of an outside expert. But of course, the appointment of an auditor implies that the company trusts the auditor not to break any confidences about the company, about the client. And if I'm starting bringing in people who are not members of the audit team or not members of the audit firm, then I'm extending the number of people who are now aware of confidential information about the client. And therefore I need the client's permission before I start bringing in these outside experts. Where would you find an outside expert? Where would you begin to look for a construction engineer to value the stage reached of the tunnel which took 15 years to build between England and France? Where would you begin to find an expert to determine the stage reached? It shouts at you. It's obvious. It's the first thing you would do. Come on. Last year's file, you would, wouldn't you? Because if you were the auditors last year, you would have had the same problem last year. And if you'd used an expert last year, then why not think about using the expert again this year? What if it's your first year's audit? What if this is the first time you've been involved as auditor, and last year it was KPMG? Well, contact KPMG and say, did you use an expert last year? Was he any good? Can you recommend him to us? There's this interrelationship between certainly the Big Four, and why not others as well, that helps themselves along, because next week they're going to be ringing you with their new client and saying, did you use an expert for this? So you would assist each other. In theoretical terms, that's what should happen. Whether that actually happens in practice is another question. But you may be able to get assistance about choosing an expert by referring to last year's auditors. But last year's file is a sensible place to start. And as a practical point, when your expert at the end of his assignment or her assignment, when your expert has finished their work and they've submitted their report in a form and content and layout and basis that you'd agreed with them, then you write and thank them and pay the money that they've charged you for their expert services and say, could we tentatively reserve your services for next year? If we still have the job next year and if it is still appropriate, would we be in order to reserve your services? This is part of planning. You don't leave planning until the last minute. You plan maybe in March when the expert has done some work for you, say, could we have your services again on the 31st December this year, so that you can do the equivalent work again this year? And that means you've sorted out, you've already planned, it's not a last-minute exercise ringing round to see which expert, inverted commas, is still available, because all the best ones will be taken. So you confirm with your outside expert the fact that you will need them in the context of, for instance, a construction engineer. Lawyers, well, lawyers tend to be able just to do the exercise. The company's lawyers would tend to do the exercise as a routine daily thing. But something like an actuary, where you use them only infrequently, or a valuer, where it's only infrequent. When I was auditor, when I was a trainee, I was involved in the audit of the builders' merchants, where they supply building material for builders. And I visited the premises, and in the inventory, which doesn't perish, is all outside, the bricks and the stones and the sand and the gravel and all the stuff which doesn't deteriorate. How am I going to determine the volume of a pyramid of sand? Yes, okay, you can work it out on the basis of mathematical computations. It's I don't know, half the height times a third of the circumference. I don't know what the formula is. But surely it must be better. And don't forget, sand also comes in different qualities. You get builder's sand, you get river sand, you get sand with grit within it, little tiny stones within it. So the quality of the sand, I couldn't do that. How am I going to do that? And it could be material. So, I don't know how I got there. How did I get there? So, yeah, we would potentially, sensibly reserve the services of the expert for next 31st December or next year end. Before using the expert, we should agree in writing with the expert the nature, scope and objectives, and the roles and responsibilities, the nature, timing and the extent of the communication. The need for the expert. We would want a confidentiality agreement from them that says any information they come across in the course of this assignment will remain confidential and shall not be disclosed without authority to anybody else. Procedures for evaluating the expert's work. Here's another thing. As auditors, we're responsible for signing an opinion about truth and fairness of the financial statements. It's our responsibility. It says within the audit report, it's our responsibility. So even though we use the services of an expert, it's still our responsibility, and therefore we need to review the expert's opinion. And an expert will come back and tell me that the underground station is 58% complete. I've got to visit the site to determine that, does it look to be 58% complete, or is it still a hole in the ground with no additional work done? Is the film that I was talking to you about yesterday, where 5 people have gone to prison for cheating the customs and excise, cheating HMRC, is the film in the process of production? Is there value to the work which has already been carried out? It's up to me to determine that the expert's opinion is reasonable. So it's a strange thing. The valuation of buildings that Indra raised. The valuation of buildings, the expert's going to look and say, well, based on the quality of the structure and its location and its age and its potential uses, and comparing it with other buildings of similar age and location, I am of the opinion that, and I've then got to assess it, because the buck, the responsibility, rests with me to determine that all material matters are fairly stated within the financial statements. So it's a strange thing. We use the services of an expert, but the ultimate responsibility is ours. It would be inappropriate within the audit report to mention the fact that the services of an expert have been used. The implication of stating that within an audit report is to say, in brackets, and therefore we are not responsible. And clearly we are responsible. So it would be wrong to say within the audit report that an expert has valued the land and buildings. You've put it by way of note in the financial statements that the land and buildings have been independently valued by an expert employed by the company, but you wouldn't include it within the audit report. Procedures for evaluating the expert's work, okay. The auditor should consider the consistency of the expert's findings with other audit evidence, the significant assumptions used by the expert, and the use and accuracy of source data. Given some examples there which we've already discussed, auditors need to obtain evidence that the work of the expert is adequate. This involves an assessment of the objectivity. I said early on, right at the start of this page, I said, where will you find an expert? And suggested last year's file was an appropriate source. But what if it's the first time of the company? You've been the auditor for a while, but it's the first time we've come across this problem. Maybe the company's only just started a pension scheme, and therefore we don't have any history of actuarial valuations. Where else would you find an expert? If you're from a Big Four firm, a Big Four audit firm, then there will possibly be an actuary, probably will be an actuary somewhere within or in the world. There will probably be an actuary qualified who will do that work for you. So it will be seconded onto the audit team specifically for the task of the actuarial valuation. There may be building experts, there may be livestock experts. How do you value livestock? How do you value sheep? This was a past exam question many years ago. How would you confirm the value of inventory for, the expression is a hillside sheep farmer? And a hillside sheep farmer, you don't tend to have many hills in this country, but in the UK where we've got great extensive stretches of moorland with no houses on them, then the local farmers are able to graze their sheep, let their sheep feed on this great huge expanse of untamed land. How do you value a flock of sheep which is roaming freely on the moorland? Because you've got to count them and value them. How are you going to do that? Well, the answer to the exam question came with some intriguing suggestions like hire a helicopter and take infrared pictures and then count the red spots on the photograph. Another one said there have to be two to count the sheep, one to count and the other one to keep waking the first one up, because when you count sheep it's a classic way of falling asleep. The sensible thing, and I don't know if I don't remember reading it in the examiner's comment, the sensible thing, sheep have to be disinfected on a regular basis, because otherwise they get something called mange, it's called. They get some disease, and so they have to be disinfected, they have to be dipped in a sheep bath. So the sheepdog rounds them all up, and then they're pushed or persuaded to jump into this disinfectant. And there's a man at the far end with a prod, and he pushes the head down into the water so that the sheep is fully covered in this disinfectant. And then, well, that's the sensible time. You sit there on the fence and you count the sheep as they go past you. That's the time to do it. Isn't it? Yeah, it is. Okay, where else might we find an expert? If we can't use last year's file, where else can we find an expert? If we don't have one within the firm, so potentially we're not a Big Four firm, so potentially we don't have our own expert in the firm's employ, where else would you find an expert?
The companies which are providing the same...
Yeah, companies which provide that service. So yeah, you actually could look in Yellow Pages, couldn't you? I don't remember subheadings in Yellow Pages that say inventory valuers, but there may be, or stock valuation experts, there may be, I don't know. In a trade magazine you could do. Maybe in the local Chamber of Commerce, contacting the local Chamber of Commerce, they might be able to push you in the right direction and recommend an expert. Maybe if you've never been faced with that before, you could ring one of the other Big Four and say, have you ever had the need to use an expert? And if so, can you recommend one? You could help each other that way. That would be a possibility. Recommendation from other people, which I've just mentioned, but not necessarily other accountants, other auditors. So these are places where you could find experts. It should not be a major problem to find one. During the year ended, the head office of Audit was valued by an external valuer. What audit procedures would you perform to determine whether the valuer has provided an accurate and reliable valuation? What procedures would you perform? I think number one is you get a copy, wouldn't you, of the valuation itself. You get a copy of the report. And if necessary, or if appropriate, you would compare that report this year with the equivalent report last year to see that it was done on the same basis, and it was the basis that we had agreed, and therefore it's consistent. Accuracy, I think it wouldn't be unreasonable to expect you to find the market selling price of similar properties in similar locations in similar conditions. I don't think that will be unusual. The reliability, how do you determine that an expert is reliable?
Recommendation.
Say again. Google. Recommendation. A recommendation doesn't confirm reliability. I don't think so. Maybe to an extent, on the basis of reputation. The fact that if the expert is shown to be unreliable, then their reputation would not be sufficient for you. I was surprised, I am surprised. Typically when I ask this question, people say qualification, an appropriate qualification. Well, I think that's a bare minimum to see that they are appropriately qualified. And you don't have to look far to understand what I'm saying. For instance, with reference to P3, P4, P5, P6, I have no idea. I'm a qualified accountant, but I have no idea about matters which are included in business analysis or strategic planning. I have not a clue. So even though I'm a qualified accountant, and therefore in theory I should know these things, I don't. Just because a person is qualified doesn't mean then that they're competent to do the job that you're expecting them to do. So you'd want to see, if applicable, that they were up to date, that they are recognised amongst their peers, their equals, as being a reputable, competent, reliable expert. Subsequent events is another matter that the evaluation of something you may get confirmation about the reliability by subsequent events. I'm still on page 36. You may get confirmation about evaluation simply by considering the impact of subsequent events, subsequent to the year end before the directors approve the financial statements. Things may happen which then confirm or call into question an expert's valuation. Okay, on to page 37, considering the work of internal audit. Surely internal auditors are themselves experts, aren't they? They're experts at internal auditing. And we're relying, or we will actively want to place reliance on the work of the internal auditors. Why would we actively want to place reliance on the work of the internal auditors? It could reduce our work. I said yesterday that internal audit is part of internal control. And auditors, external auditors, will assess the internal controls of the company to determine their strengths and their possible weaknesses and make a decision as to control risk. And one of these internal controls is the internal audit department, or the internal audit function. So we will want to place reliance on them because that can reduce our substantive work, because we can increase our materiality level and still have an acceptable level of audit risk. So active reliance on the internal audit function is what we're looking for. But before we can actively, positively rely on them, we need to assess the work that they carry out and assess their competences. They are in internal control. How do you determine the strength of an internal control?
Validation.
With?
Validation.
with validation to see that the internal control is actually working. You perform control tests. Well, you perform control tests on the internal auditors as well to confirm that the reports that they produce appear to be reasonable, appear to be competent, appear to be professional and thorough, comprehensive, reliable. So by assessing the quality of their reports, that can give us a feeling for how reliable this internal audit function is. External auditors, top of page 37, should consider the activities of internal audit and their effect, if any, on the external audit procedures. We need to assess the function during the audit planning. Why? Because we will assess the quality of internal controls during audit planning to determine are we going to do a test of control type audit with reduced substantive testing, or are we just going to move straight into substantive testing? This is assessing the quality of an internal control, and it's done at planning stage. Just because there is an internal audit function, this doesn't in any way reduce our own responsibilities. If there is an internal audit function, that's good, that's great. It's another control established by the management in order to carry on the business of the company in an orderly and efficient manner. So, yeah, it's good news that there is an internal audit function. When would you not rely on an internal audit function? Even though the members of the internal audit function are apparently highly competent. When would you not rely on them?
They do not produce any reports?
Yeah, if there's no written evidence of the work that they've done, then clearly we can't. But that would be unusual. I don't think the audit committee would accept that there's no written reports. But yes, okay. Another reason surely would be where the number of staff involved in the internal audit function is minimal, where it may be the most competent person in another country where I teach. The chief internal auditor of a group of supermarkets was an ACCA prize winner, a world prize winner. And she's now chief internal auditor, but, and I don't think she is, if she were the only internal auditor in that audit team, then she's going to be overworked. The competence that she can demonstrate is unreliable in terms of there's too much work for an individual. It may not be. Maybe you only do need one, if at all. But in that situation where you can see that the logistics or the practicalities facing the internal audit function are too onerous, too difficult, too extensive, then you'd have to question whether you could rely on that internal auditor. Criteria for assessing internal audit function: organisational status. That's asking the question, to whom does the internal audit department report? To whom are they directly responsible?
Internal?
To?
Audit committee.
Yeah, to the audit committee. And if there is no audit committee, then direct to management, the executive board. But ideally to the audit committee. If they are responsible to some executive member of the second layer, then that's not acceptable. It's got to be direct to the highest level. And the highest level are these supervisors who sit on the clouds and watch the activities, the audit committee. So they should be responsible and regularly meet the chair of the audit committee, the non-executive chairman. They should not, therefore, be responsible to anybody else within the organisation. In a pyramid structure, the internal auditors do not lie within that pyramid. They're outside the pyramid as an extension to management. The scope of their function, whether they are given free rein, whether they are given total freedom to determine the areas which they're going to focus their attention on, and whether there is any restriction on the availability of information which is provided to them. Are they being prevented from access to personnel or to locations? And if there is any restriction imposed upon them, then we have to question the reliability of their reports, as well as the integrity of management. There should be no restrictions placed upon the internal auditors. They should have total access to anything and everything and everybody. The technical competence is typically judged by qualification, But not necessarily, and don't forget also that the internal audit function is not necessarily confined to people with a financial background. Just because you're an internal auditor doesn't necessarily mean that you're a qualified accountant. There could be chemists, or quantity surveyors, or lawyers within the internal audit function. People who are specialists in their own field within that internal audit department. I can imagine a drug company, a drug manufacturer. I can imagine them employing a chemist or a doctor in order to serve on the internal audit function, internal audit department, the internal audit team, because a financially trained person tends to be number orientated, but in a drug company, surely the viability of a drug would be better determined by someone who's used to dealing with drugs. And hopefully that's not too many accountants used to drug dealing. So you'd expect a doctor or a chemist to be involved in that. And do professional care, are they competent? The quality of their reports. Another way in which you can assess their reliability is to see what is the management's reaction to the submission of an internal audit report. When the internal auditors submit their reports on any particular aspect of the company, what's management's reaction when they receive that report? And if they don't discuss it at a board meeting, and if they don't take any remedial action in accordance with the recommendations, and if they simply bin the report on the basis that, well, an internal audit has been carried out on this element of our company, but we're not going to read it or pay any attention to it, if management are prepared to ignore it, then surely the external auditors should also ignore it. As a general rule, external auditors should be involved in the audit of all material matters, and of those where there is significant risk of error or misstatement. And if the external auditor decides to place reliance, then the timing and the extent of the work should be agreed with the chief internal auditor. It is potentially the case, or it was potentially the case, although I seem to remember reading an article within the last 3 weeks, it is, or has traditionally been the case, that external auditors may second or have seconded to them an internal auditor or the team of internal auditors to assist in the external audit. It would not have been unusual for that to happen because they are aware of the computer systems. They have probably a greater in-depth appreciation of how the system is meant to work. They know the personnel to whom questions should be directed. They can do donkey work, so when you get receivables responding, then you can give the reconciliation exercise to the internal audit department. But you can't rely on them in full. You cannot ever, on any material matter, place 100% reliance on the internal auditors. Why? Because they're not external auditors. They're not us. They are technically employees of the company. And it's like saying, well, I can rely on the purchasing manager, or I can rely on the machine operator to tell me how many goods have been produced. You can't rely on these people because they are internal. But you can use them. For instance, in the receivable reconciliation example, 30 non-replies or 30 disagreed replies, responses, then the internal auditor can perform the reconciliation on those. But the external auditor then has to take a sample of those 30 and re-perform that reconciliation exercise to see that the internal audit work has been competently carried out. Accounting estimates, including fair value accounting estimates and disclosures. Oh, I'm sorry, I mentioned that just before I leave internal auditors. I think I read an article within the last 3 or 4 weeks that said that it is now considered no longer appropriate for external auditors to use the services of an internal auditor. So the internal auditors should not be seconded to the external audit team. That's a recommendation. I don't think it's in any standard. It's a recommendation that in order to maintain the image of total independence, then you should not be using the services of a person who is not seen to be totally independent. So that's a new proposal, I think, is the best I could say it is. It's a new proposal to maintain or to continue to maintain the vision of the external auditor's independence. Accounting estimates increase requirement for auditor to exercise greater scepticism. I said that yesterday as well, didn't I? That there's a recommendation that this healthy degree of professional scepticism is recommended and encouraged to be greater than a healthy degree of professional scepticism. And it's tending towards the recommendation that when you go to visit a client and you're on audit, it's tending towards saying you anticipate that things will be wrong or that fraud is being committed. It's tending towards that, and those are my words. I didn't read that in the article. These are my words. But if you've got this really, really healthy degree of professional scepticism, then you go in with almost a blinkered vision. You're saying this client is committing fraudulent activities, creative accounting, aggressive earnings management, and you go in expecting that to take place, to have taken place. This is quite contrary to one's natural desire to believe that people are honest. And I like to think that people are honest. As a result of that, personally, I have suffered quite a lot in terms of finances. I've suffered a lot. I had to sue a former partner of mine, take him to court and get some money back out of him. I believed he was honest, and he did nothing illegal, he did nothing dishonest, but it was quite clearly unethical. And you want to believe that people are ethical. You like to believe that people have the same standard of ethics as yourself. Increased requirement for auditors to exercise greater scepticism should consider the likelihood of management bias in the estimation process. I was looking at the Devro accounts this morning before you came in, and part of their remuneration package is index linked to the performance of the 100 companies, 50 above, 50 below, in terms of market capitalisation and industry. And if they score less than 50%, if the Devro is less than 50% of the average, then they get no bonus. And they get the full bonus if it's in the top fifth. It's called a quintile. If they're in the top quintile, then they will get the full bonus. And anywhere between, they get a sliding scale bonus. Well, there was quite clearly an incentive or motivation for management bias to manipulate the figures in order that total shareholder returns should be in that top quintile in order that they get their full bonus. So you have to be aware that management, this is P1, that management have a conflict of interest, that they would dearly like to see their company do well, because a company doing well will influence the extent of their bonus. And therefore, there may be bias in the area of estimation. And you have to be conscious of that possibility. We need to obtain an increased understanding of the process and then related controls, the process for estimation, and then related controls which control the procedures involved in arriving at an estimate. Things we can do, we can determine whether any subsequent events provide additional evidence about the estimate. Look at the accounting records, therefore, subsequent to the year end, to see how the estimated item resolved itself in the new year. Determine managements. We need first of all to get a thorough understanding of the procedures that management have adopted, or that the company has adopted, for this process of estimation, and we'll test the management's methods of measuring the estimate and any assumptions that they have made. Test the effectiveness of controls over the estimation process. Is it the case that more than one individual is involved in estimation? Is there a discussion about the estimation? And develop a point estimate or range estimate to evaluate management's own point estimate. Develop your own point estimate on the basis of analytical procedures. See if you can get a point estimate which will give you a range of figures within which you feel the estimate should lie. Sampling. I'm going to ask you to read down sampling. So can you read the whole of page 38? Okay, any problems with that? I remember teaching a course again many, many years ago, and we're talking about sampling, and a girl from a firm said, we've determined in our firm that an appropriate sample size is 62. 62 is the sample size. Which is a strange thing, and a colleague of hers, a man, said that's only because there are 33 lines on a page, and if you have the carry forward line and the brought forward line and then the total line at the bottom, that's 31 lines you can use, and that's why the sample size is 62. It's nothing to do with any scientific or mathematically calculated sample size. It was just that they decided that a sensible sample would be 2 pages worth of items to be selected from a population. It was also that same guy who said, in an audit, recent audit before he came on the course, he said, we, working on a sample, this 2% and 2 out of 20 wrong, therefore 10%, he said, we calculated a sample deviation, we calculated a sample error, and we discovered it was 2%, so we asked the client to change the figure by £750,000, but I'm talking a number of years ago. So we asked the client to change it by £750,000, 3 million of your currency, and just on the basis of an extrapolated error rate applicable to the value of the total population. They didn't do any additional work, they didn't pass it back to the client and say, can you do better, can you recompute the figures in order to get us a better figure. They just said, can you change it by 750,000? And they did, the client did. Which seems a bit distant from the fundamental truth of double entry, that figures are self-balancing. Page 39, related parties. Basic assumption that businesses trade with each other at arm's length. Of course there is, because they do. However, if there is a relationship between two businesses, this assumption may not reflect reality or commercial reality, because it may be that an individual who has a significant influence over two separate companies may significantly influence one to sell at a lower rate than would be normal, or at a higher value than would be normal, in which case the financial statements do not fairly reflect the activities of the selling or the buying company. The buying company is being allowed to buy at a heavily discounted rate, a heavily discounted value. So the existence of related parties can have a material effect on the commercial reality and the truth and fairness of a set of financial statements. And it's the auditor's responsibility, it's the director's responsibility to identify who the related parties are and to list out the details of transactions, the related parties with the company, which then is produced to the auditor, and the auditor has to audit. Not just the audit of the listed out related party transactions, identifying who the related party is and the value of the transaction, but also to identify that all transactions of related parties have been recorded and disclosed, and that all related parties have been disclosed. So, parties are considered to be related where one party has the ability to control the other, or they're both under common control. Material related party transactions must be disclosed in the financial statements. The auditor has an obligation to perform audit procedures to obtain sufficient appropriate evidence regarding the disclosure of related party transactions and the control of the entity in the financial statements. Management responsibility. So the audit has responsibility to ensure sufficient appropriate evidence regarding disclosure, and management is responsible for the identification and disclosure of those transactions. The auditor should review the information provided and should be alert, should be aware of the possibility that there may be other material related party transactions. What procedures should be performed to identify related parties. Where would you start? What's the first thing you would do? You'd look at last year's file, because the senior management and the company and the group structure is unlikely to have changed much. So your start point surely is last year's file. What names are we looking for? What company names are we looking for? Because these were the identified related parties last year. But of course, things change. So you've got last year's schedule, and you've asked the management this year, could I have a schedule of your related parties? What's the next thing you're going to do? Compare the two to see what the changes are. So this is what auditors do. Auditors audit change. If it was a related party last year, and it's a related party this year, then we're happy, potentially. But if it's a new name, if the name last year does not appear, so we've lost one, or it's a new name, we've gained a related party, then the auditors need to confirm the adequacy of the completeness of the disclosure of these related parties. So obtain a schedule from management, look at last year's file and compare the two. That's one step or two steps towards the identification of related parties. What's something else we could do? Look at the group structure. Look at the group structure, determine whether there are any new joint ventures, associates, subsidiaries. Look at the group structure. So you will have obtained from your consolidation planning, you will have obtained a copy of the group structure from management. What else might we do? Look at unusual transactions. Transactions material. But of course in related party context they're all material because they all should be shown. Look at transactions which are unusual. Often just before and just after the year end, which might indicate aggressive earnings, aggressive management, creativity. So look at the accounting records, bearing in mind that throughout all the other work you've been doing during the course of the audit, you've been aware of the identity of the related parties. So when you're considering a sales system and doing a test of control on sales, then you need to be aware of the identity of the related parties to see whether any sales have been made to those related parties, or any purchases bought from related parties. Any disposals of assets which have given rise to an unusually high loss. So selling an asset at less than market value to a related party. Bearing in mind this throughout the course of the audit. It's not a one-off exercise. You're not going to turn to your computer maintained audit file and say, what's the next thing I have to do? Oh, it's related parties. Let's do the exercise on related parties. This is an ongoing thing throughout the entire course of the audit, even at the planning stage. At the planning stage, the senior in charge should call the members of the audit team together, maybe over a drink on a Friday night, saying, well, we know we're going to this client on Monday. These are matters which we ought to be paying attention to. You, I want to be looking at fixed assets. You, I want to be looking at receivables and payables. Allocating the work. And all of you, be aware that throughout the course of the audit, you're bearing in mind the identity of the related parties. There's a schedule on file. You're bearing in mind things like contingent liabilities. You're bearing in mind indicators to suggest that the company could be facing going concern problems. These are ongoing matters throughout the course of the audit. So right from the planning stage, right the way through the audit, and at the end of the audit, at the review stage, these things are right the way through. During the audit, we should be aware, we're still on the example 5, what other matters might we consider to identify related parties? Oh yeah, there is one. Not for the identification, but for the confirmation that we have completeness of identification. Individual written representations. I confirm that I have made full disclosure of all the parties who could be classed as related. During the audit, we should be aware that certain transactions may indicate the existence of unidentified related parties. Transactions, I've covered most of this. Can you just read those 6, 7 bullet points? I've covered the last one as well. The auditors obtain written representations. And over the page 40, if we're unable to obtain sufficient appropriate evidence about related parties and transactions with them, this gives rise to a limitation of scope. It should not be the case that we are unable to confirm to our own satisfaction the completeness of that disclosure. We ought to be able to do that. But it may be that we're unable to contact an individual director. He's away, he's in hospital in a coma, and we're no longer able to get written confirmation from an individual director. That would give rise to a limitation of scope if it were material. So you would qualify on the basis of that uncertainty. If we conclude that disclosure is not adequate, that gives rise to a modification on the grounds of material misstatement. It's a qualitative qualification rather than a quantitative qualification. If the disclosure is tricky or ambiguous, then that would be a qualitative qualification within the audit opinion. A material misstatement. Materiality does not itself necessarily involve money. It's not a value concept all the time. Sometimes it's a quality of disclosure concept. Documentation, document and the working papers matters that are important in supporting the report. The file should support the statement in the audit report regarding the conduct of the audit in accordance with auditing standards. We have conducted our work in accordance with auditing international statements on auditing. The audit file should demonstrate planning, the procedures carried out, conclusions of the procedures carried out, and the results then of the audit work. This should be reviewed. It's continually subject to review process. As work is completed by one layer of the audit team, the higher layer, the next layer up, will be reviewing the work of that member of the audit team. And the member who's higher up, the A1 or the senior assistant, their work will be being reviewed by the manager, and the manager's work will be and so on. So up the pyramid of the audit firm, there is a review process being carried out. The partner should ensure there's proper documentary record of discussions and conclusions relating to, particularly, to going concern, provisions, subsequent events. Another one I suggest you could put in there, related parties. Just those three, going concern, provisions, subsequent events, are just three elements by way of examples. A review, at the end of the audit, review procedures will help to ensure that all material issues have been properly dealt with. How do we know that all material issues have been properly dealt with? How do we know what's a material issue? No, that's how we can determine that material issues have been dealt with, but how do you know what is a material issue?
Which impacts the decisions.
At the planning stage, we will have identified what are material issues. There may be other material issues which come to light subsequent to the planning stage and during the course of the audit, but planning is the major stage of the audit for the identification of material matters. And if there's anything unusual, then the manager should be, and the partner, should be put on alert, should be aware of the fact that this is something new, we'd never come across this before, and suddenly we've got this new matter which is material, which we'd never identified or didn't exist in prior years, and it's something for the partner to be aware of, and next year's audit senior to be aware of in the planning process for next year. Because it's unusual, we didn't plan to have to do work on that particular area, and that has now extended the time of taking on the audit, because what we didn't think or haven't recognised as material has now required some audit work to be carried out. Equally, what we planned and thought might be material may prove to be not material, and therefore we can save time on the audit by reducing the extent of our work on this less than material item. Discussion between reviewers and those involved in the audit should take place to allow the reviewers to understand the approach and the thought process behind it. The audit approach should have been written down. It should be within the audit plan. It will also enable reviewers to determine how well the audit team understood the client. When you're planning as an auditor, when you're planning an audit assignment, it's not unusual, part of planning, it's not unusual that you should estimate the length of time it's going to take to perform individual audit functions, or audit procedures, and the level of the audit team, the level of seniority of the audit team member who's going to be allocated that particular procedure to carry out. How do you start to prepare the audit plan? Last year's style. Yeah, last year's file. You don't start everything. It's the same with cash forecasts and budgets, isn't it? Budgets tend to start with last year's budget, or maybe even last year's actual. They tend to start with a base which has been confirmed, or a base where all the groundwork has already been carried out. And then it's updated, it's rolled upwards as time goes by. In order, we're looking for an increase in sales, but that's going to increase our profit, requiring to increase our productivity, which will increase our cost of sales, but that should increase growth. And surely, you're not going to sit down every year and say, how many sales are we going to make this year? I don't want to know how many we made last year, how many we're going to make this year. It's inconceivable to start zero base. So it's the same with this stuff, the materiality things and the review, and planning the audit and how long the audit is going to take. You start with last year to see what was budgeted last year. Now, being a true cynical person that I am, it would not be unusual that the firm demands that the budgeted time should be reduced by a percentage each year. So as the learning curve takes effect, as the assistant becomes a senior assistant, becomes a junior manager, becomes a manager, then they become more efficient and more expeditious in the work that they carry out. You can do the same work quicker this year than you did last year, and therefore the time taken should be reduced. So the audit plan is often a target, and if you don't attain that target in terms of the audit plan and the time to be taken, that causes knock-on effects through other things, because I'm having to work an extra 2 days on this audit, which means I can't start the next one until 2 days later, and I can't start the one after that until 3 days late, and it has a knock-on effect. Now, where there are strict deadline dates for the submission of financial statements, like I believe in this country, the public companies are required to submit their accounts by, effectively tomorrow, by Sunday, this Sunday. And in that situation, if I'm 2 days late starting that audit and then 3 days late starting the next one, then suddenly I'm running over the deadline, and there are then repercussions. But you can apply for extensions, I believe, if it's not your fault. There are situations, aren't there, where you may be granted an exemption.
For public, no.
For public companies, no. So the whole of your colleagues are busy and will be busy over the weekend as well. And Monday, because fortunately Monday's a national holiday, so they'll be busy Monday, and they'll put the financial statements through the letterbox of the registrar and say that it was there on Sunday night. Please don't agree that that's true. No, that will be unethical, untruthful.